Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our May 2016 IFRS Insurance Webcast. Today's webcast is titled Solutions to IFRS 9 and IFRS 4 Phase 2 Decoupling. The ISB completes its work and targets publication in September 2016. Our agenda for today's webcast is structured around three usual items. First one is highlights of the ISB meeting held on 17th of May 2016. Then we'll do a deep dive into the analysis that the ISB staff prepared, the recommendations that they put forward, the discussion that followed, and the decisions that the ISB has taken on each of those recommendations. And then very briefly for this webcast, we will also look at the next steps. The highlights are effectively taking this IFRS 9 decoupling project to its very end in terms of the public discussion around the content of this solution. And we have a number of important refinements on the two approaches that will be comprised in this solution. The first approach is the deferral approach, where we have seen decisions confirming the need to have in the new amendment to IFRS 4 a mandatory reassessment of eligibility for the deferral approach. So the deferral approach can be earned at the start when you do the calculation of your predominance of insurance activity based on the rules that I explained to you last month, but that eligibility could also be lost. And also if you have not achieved it in that period, you can still gain it, and I will explain later on under what conditions both events may happen. The second decision is that the ISB confirmed the desire to have a sunset clause for the deferral approach, and so this solution will be available only for 3 years. It will begin on the 1st of January 2018 and will be over by the 31st of December 2020. So on the 1st of January 2021, no matter what happens, you will have to adopt IFRS 9 if that has not happened already. And finally, the ISB also agree that they will allow voluntary termination of the deferral approach from the start of any subsequent year. So if you are planning to do that, you know that you can do that from the 1st of January of the following year that you have announced that decision. On the overlay approach, the key decision is that it will not come with a fixed expiry date. So that remains open-ended as long as the project on insurance contracts IFRS continues, the Phase 2 project, the overlay approach will be there to provide an alternative solution to the deferral approach. When the effective date is set and it has actually occurred, then that's the end of the overlay approach. And then two other important decisions they apply to both approaches. The first one is the board agreed to allow non-uniform accounting policies to be in place within the same reporting entity for financial assets when those differences arise purely from the accounting policies used in the equity accounting method of joint venture and associates compared to the accounting policies of the investor. And the other one is that the overlay approach and the deferral approach will now be available to first-time adopters under certain conditions. Finally, the balloting process has been approved, so the ISB staff has already started the drafting process of the amendment to IFRS 4, and the publication of this amendment is targeted to be the September 2016. So quite a number of decisions, and let's move on to the first one. And I have to inform you that the decisions and the debate were fairly swift. You will see as we come through the first one, but there is quite a lot to explain as to what the topics were and what recommendations were put forward. So please bear with me. I will walk you through each component of this decision so you may appreciate fully the content of what has come out of the board discussion last week. So reassessment of eligibility for the deferral approach. The first slide talks about when there is a mandatory reassessment of eligibility, and the staff here conducted an analysis which opened up effectively the debate. The analysis identified first the fact that an entity shouldn't be eligible if those activities that are carried by the entity no longer meet the predominantly insurance characteristics that are effectively the foundations of the deferral approach. An example of when this could happen is the reporting entity that was eligible acquires a significant banking business, and as a result of that dilutes the predominance of insurance liabilities on its balance sheet. There is also the point in the analysis that an entity would not be required to perform a reassessment if there is merely a change in the level of insurance activities relative to the total liabilities of the entity. So changes which may be driven by market variables, for example, would not constitute an appropriate basis for conducting a reassessment based on this analysis. There is also the point that if such criteria of identification of a change set of circumstances has to be defined, then a demonstrability test is probably necessary, something which can be actually demonstrated to external parties. And a change in the corporate structure would be an example of that, something that doesn't occur all the time in the history of a business. And the other point is that whatever is the ultimate outcome of this debate, the staff noted that disclosures will be required, some special disclosures, because they need to, the reporting entity will need to explain when the reassessment happens and what does it lead to in terms of the reporting of financial assets in the financial statements. When an entity has got the reassessment from a situation that we're not meeting the predominance criteria that I explained to you in the webcast last month, then again the staff analysis suggests that there should be an option for that entity to reassess if it wanted to, but it should be also subject to the same conditions. In addition to those conditions, which are effectively the one related to the significant event that I was talking about earlier, it would also require some other basic condition. Effectively, that entity should not have adopted already IFRS 9. You cannot reverse the adoption of IFRS 9. If you have adopted it, then it will not be available for you to reassess the possibility of deferring something which has already been part of your financial reporting reality. The only exception will be if you have adopted only the own credit risk requirement in isolation, so a particular version of IFRS 9 that came out a few years ago. The staff analysis also led them to conclude that there doesn't appear to be a compelling reason to have a different trigger from a change in predominant activities, and you will see in a moment in the recommendations that came out with the same trigger. The point here is that you may become eligible after the period that the staff and the board approved last month should be used to test for eligibility. So if you have carried out within your balance sheet in the period that goes from the 1st of April 2015 to the 31st of March 2016, and you have realized that you are not eligible, it's important that if there are certain conditions that you are given the option to perform another reassessment, and if you pass, be given the opportunity to defer IFRS 9. So with that analysis in mind, the recommendation is quite lengthy. So I have tried to spread it over 2 slides, but also I've used this bold font for keywords that I believe are important for us to discuss and debate during the webcast. The first recommendation is that an entity will be required to reassess whether the predominance of insurance activities is in place if there was a demonstrable change in the corporate structure that could result in a change in that condition. So that is a requirement that whenever there is an event called a demonstrable change in the corporate structure, then the reassessment must be done. And that is for those entities that have elected to be exempted from the application of IFRS 9 in 2018. So people that have got this right in place. And this right is one that you may not have yet applied to your financial statements, because you may still be in the leading up to the 1st of January 2018, which is when the deferral approach effectively pays its benefits to those that have it. The second recommendation is that an entity that is required to carry out this reassessment should compute the predominance ratio using the carrying amount of the liabilities that are at the end of the annual reporting period following the change in the corporate structure. So this recommendation effectively says if I buy a bank this year in 2016, then, and I know that I was eligible because in that bracket, in those 12 months, I passed. I had more than 90%, 91% in my ratio, so I was in the safe harbor. And I buy a bank in 2016, then in the example where I am a calendar year reporting entity, I would need to calculate the predominance ratio using the balance sheet on the 31st of December 2017. So the bank is bought this year, 2016, then I need to test the predominance ratio using the 31st of December 2017, the period immediately following the change in corporate structure. Corporate structure changes in 2016, end of 2017 is the assessment. If at that point, at 31st December 2017 in this example, I fail to pass the predominantly insurance criteria, and I have gone down from 91% to say 75%, then I lose my right to defer IFRS 9. So I'm still prior to the effective date. So that means that when the effective date arrives for IFRS 9, I can no longer defer it. I have to be ready on the 1st of January 2018 to adopt IFRS 9, which happens to be exactly the day after the testing of the predominance test. So if we repeat now, just for further illustration, the same example, and say I buy a bank in 2017 instead, I will have to carry out my assessment using the 31st of December 2018 balance sheet. And if on that balance sheet date I fail and I move down from 91 to 75%, then the effective date for me on IFRS 9 becomes the 1st of January 2019. So I've been able at least to defer because of my eligibility acquired in those 12 months in 2015, be able to defer the IFRS 9 effective date by 1 year, but 1 year only. On the 1st of January 2019, I must apply IFRS 9 because now I lost the eligibility to continue the deferral of that standard. Now, if that is the conclusion, that you have lost the predominantly insurance-related activity condition, then you need to apply IFRS 9 from the earlier of its second annual reporting period, which is effectively the first day after the balance sheet date. So if you remember in the first case, assessment on the 31st of December 2017, application on 1/1/18. Assessment in the second example on the 31st of December 2018, application on the 1st of January 2019. This condition is trumped if we are getting too close to the sunset clause, and that's why the condition number 2 is the earlier of that second annual reporting period, or effectively the sunset clause. And so if you are ending up with this mechanism of the second annual reporting beyond the 1st of January 2021, that bites, and you get a shorter timeline to implement IFRS 9, because nobody can defer IFRS 9 beyond the 1st January 2021. That is the absolute limit. If you are in this situation, then the recommendation also requires disclosure. 3 major disclosure pieces. The first one, you need to disclose the fact that you as an entity have now lost the eligibility to apply the deferral approach. 2, you need to explain the reason why that is no longer the case. And 3, you need to explain when this has happened and what was the event that happened which made you ineligible. Again, linked to the fact that there is a need for these change in corporate structure to be demonstrable to external parties. And in fact, let me just take you down to the very bottom of this slide, which is actually a requirement that applies always to these change in corporate structures, is that they have to be significant, and they have always to be demonstrable to external parties. So these 2 characteristics must be in place. This second slide talks about the other scenario of an entity that actually failed to be a predominantly insurance activity entity by testing its balance sheet in that 12 months bracket that I told you earlier. But as a result of an acquisition of an insurance business, for example, is now permitted to reassess its eligibility because there was, again, a demonstrable change in its corporate structure. Same trigger in both instances. The one that effectively could lead you to lose the eligibility, and the one that could lead you to gain the eligibility after failing to achieve it in the first place. This, of course, has to be done before the mandatory effective date of IFRS 9, because if it happens after that point, then this is gone. The second recommendation in this page says that an entity that is permitted to reassess its eligibility would calculate the predominance ratio using the carrying amounts of the liabilities reported at the end of the annual reporting period immediately following the change. So identical, symmetrical time frame for the calculation of the ratio as the one in the previous page. And in terms of disclosure, similarities again. Disclosure number 1, you need to explain the reason for the reassessment. Disclosure number 2, you need to provide an explanation of what happened in terms of activities that have led you to assess them now to be predominantly insurance. And 3, you need to give the date and explain what was the change in the corporate structure that made it possible for you as an entity to become eligible. So as you can see, a very comprehensive and fairly complex mechanics of executing this reassessment. And so we better get used to it, and hopefully this webcast has helped you to start understanding where the ISB is going. In terms of the debate, fairly short debate, but a couple of interesting points. The first one was a question from one board member who wanted to clarify how broadly a change in corporate structure should be interpreted. And the staff stated that these should be considered when there was a significant change in the business, for example, acquisition of a bank or the disposal of an insurance company or vice versa. And there was no intention in the drafting of their recommendation that simply drifting of values up and down in the balance sheet would create a change in corporate structure. It is something substantive, significant, and demonstrable to external parties. So that's why those two characteristics are so important in the recommendation the staff has put together. The second interesting question that came out from the debate from another board member is whether the existence of a definitive agreement to for example, sell an insurance subsidiary at the reassessment date, but before the mandatory effective date would be considered as sufficient if it is, for example, pending regulatory approval. The staff confirmed that they would follow exactly the same logic as they follow for business combinations in IFRS 3, and until the transaction, the business combination, is not complete and consumed between the parties, then it doesn't count. And so the date of acquisition effectively is the point where you are considering the reassessment date in the timeline. After all these explanations to the two questions, the chairman called for the vote, and as you can see, it was unanimous in approval of all the recommendations from the ISB staff. Then the next paper was tabled, and this is the one that brings back the sunset clause and also opens the question about the sunset clause for the overlay approach. The staff analysis, I summarize it around 3 points. The first one is that discusses the temporary exemption and the fact that the analysis explained to the board that the sunset clause is there because the referral approach is useful only if it is accepted to be on a short period of time. If that short period of time contains the date by which point in time IFRS 4 phase 2 becomes effective on a mandatory basis, that's good. But if not, IFRS 9 becomes effective on the sunset clause, and the reporting period from which IFRS 4 phase 2 becomes mandatory is going to be later, 1 January 2022, for example. And so the staff is clear that these 3-year period is their target for the effective date, and so we'll see whether it's going to be 2020 or 2021. I don't think that based on the conversation and the debate to date, we can see a significant emergence of a view inside the ISB for any later date, but time will tell. The second point on the analysis on this page is regarding the overlay approach. This approach provides additional information about the effects of moving from IAS 39 to IFRS 9. So because effectively you have implemented in full IFRS 9, the staff did not think that there was any particularly compelling reason to prohibit an entity from applying the overlay approach for longer. And the final point is that given that the deferral approach results in IFRS 9 information not being provided, for the same reason that the overlay approach should continue, that is the reason why the deferral approach should be actually confined to a short period of time only, almost like as an antithetical set of reasons for one to have a time frame compared to the other. And clearly the analysis indicated that this is the almost opposite view that the two approaches carry in the mind of the ISB staff. So when they came to the recommendation, a lot of confirmations from the exposure draft were tabled for vote. The first one is confirming the sunset clause on the 1st of January 2021. The second one is to confirm that an entity that has used the deferral approach may abandon it and voluntarily start the use of IFRS 9 from the 1st of January of the subsequent period in which they have made the announcement that they abandon the deferral approach. The third recommendation is that if an entity has chosen or is required to stop the application of the deferral approach, they should apply IFRS 9 for the first time using all the relevant transition requirements that apply to IFRS 9 on first-time adoption in 2018 for all the other entities. And that these entities should also be permitted, but not required, to apply the overlay approach if that is what they wish to do after implementing IFRS 9. The recommendation then on the overlay approach not to have a fixed expiry date was also put forward in line with exposure draft, and also that the temporary exemption, the deferral approach, will only be available at the start of the mandatory effective period of IFRS 9 for all other entities, the 1st of January 2018. On the contrary, a small refinement here on the exposure draft, the overlay approach will be available for any entity that first applies IFRS 9. So also for early adopters, they can early adopt IFRS 9 and select the overlay approach as one of their accounting policy choices upon application of IFRS 9. Even shorter debate on these set of recommendations. One board member asked if it made sense to continue to apply the overlay approach, given that there may be an unexpected delay in issuing the insurance contract standard as a result of that. The other board members did not feel that this would be a concern, that they would actually support and endorse. And so when the board was called for vote after that very short debate, all recommendations except for the decision to not introduce an expiry date for the overlay approach were approved unanimously. That one decision, the one to give the overlay approach an open-ended life, effectively that can only be terminated by the effective date of IFRS 4 Phase 2, was voted against by one board member. So again, very large majority, very little debate, but this board member felt strongly about diluting any purity of reporting under IFRS 9 beyond a finite period of time. Then the staff moved to the third paper. This is the relief for investors in associates and joint ventures. It's something that has been brought up by the comment letters, and the analysis that the staff put forward indicated that clearly IFRS as a framework is based on the foundation of the IS8 consistency principle, which means that for same transactions you must apply the same accounting policies. And so when you are an investor and you got investments in associates or joint ventures under the equity method, you must adjust the equity method accounting values to make them compatible fully to your accounting policies. So if there are differences in the accounting for financial assets, should that be seen as a concern, or should the standard give an exception that effectively allows the investor to maintain diversity of accounting policies? Now, in the Deloitte letter, we actually argue that the pragmatic view or diversity of accounting policies should have been seen more extensively, and we'll see what's going to happen on this particular exception when the standard setters comes to vote on it. The staff thought about the information that the investor may need in order to unwind the application of IFRS 9 or vice versa, and make the equity accounting adjustments compatible with the investor's accounting policies, and felt that this could be a timely issue in terms of obtaining all the information, and potentially also some cost-related matters. So they felt that maybe this exception is considered. It could be taken on a practical basis, and on that basis, they would look at an application in both directions. That means you can leave it as an exception both if the investor has adopted IFRS 9 and the joint ventures and associates didn't, or vice versa. Because a reporting entity doesn't really need to apply the overlay approach to all the qualifying assets, and investors may choose to apply the overlay approach to some of the assets on its balance sheet, and also not to apply it to the assets in the equity accounted joint ventures and associates. So that approach, unlike the deferral approach, doesn't appear to be contradictory on the IS8 accounting policy, because effectively the overlay approach introduces a designation basis. So by that I mean that there are effectively stated conditions that will allow two accounting policies to exist in terms of the bottom line, but that objective is achieved by effectively providing a full implementation, a full transparent implementation of IFRS 9 in all the other lines of the financial statements. So because of that, the staff concluded that there is no need to provide any relief for the overlay approach. So the focus was really around the deferral approach. And more on that issue of the overlay approach came in further a couple of pieces in the analysis section of the paper. The first point here is that an entity may elect to apply the overlay approach only when it first applies IFRS 9, and so in that instance it wouldn't elect to apply the overlay approach when it's not permitted to apply in subsequent periods. And so if in subsequent periods makes an investment in an associate or a joint venture, then the entity must unwind the overlay accounting when applying the equity method. So that is another practical consideration that the ISB staff analyzed in their paper. So having said that, the recommendations that they put forward were four. The first one is that an investor that applies IFRS 9 should be permitted but not required to retain the S39 accounting policy used by an associate or a joint venture that applies the deferral approach, and an investor that applies the deferral approach should be permitted but not required to retain the IFRS 9 accounting used by its associate and joint venture, so the two-way approach that we talked about earlier. The second recommendation is that this relief should be available on an investment by investment basis. The third recommendation is that the investor should reproduce in his financial statements all the disclosures required to be provided by IFRS 9 in the financial statements of the associates and joint venture that have applied either the temporary exemption or the overlay approach. That's similar to the disclosure requirement that we talked about last month that applies to the subsidiaries of a deferral approach reporting entity which have not been able to defer IFRS 9 in their standalone financial statements. And the final, fourth component of the recommendation is that an investor should present the amounts disclosed for individually material associates and joint ventures to be those included in the financial statements of those associates and joint ventures, not the share of those amounts. And it will be able to aggregate the amounts only for individually immaterial associates and joint ventures that become material in aggregate. In that case, then the investor can disclose the share of those amounts included by the application of the equity method. The discussion on this point was again brief. I think I captured a few points here that would be worth sharing with you. The first one is a question from a board member regarding the basis for that recommendation from the staff, and the fact that it appeared to her that this would be acceptable only on a pragmatical point of view, and that board member stated that she would be okay to vote, but only on that basis, because she saw no conceptual ground for what was proposed. There was another question asked by another board member, and the staff confirmed in that context that these disclosures would be required even if both the investor and the investee would be applying the overlay approach. A third point was the one that was raised by another board member. This board member stated that the new IFRS amendments, the new IFRS 4 amendments, should make it clear that this judgment about the cost, the timeliness of obtaining information should really be based on facts and circumstances, and it should not be given so easily to the investors. Another board member actually disagreed with that, and the majority of the board were actually of the view that this was more of a nuanced decision, and there was not effectively a clear basis to make it more difficult for an investor to call for that relief. Finally, in response to another question, the staff confirmed that the option to use the relief, once made, should be irrevocable up until the last day in which one of the two solutions to the IFRS 9 decoupling remain in place. And at that point, the chairman called for a vote, and the debate clearly has been effective in addressing the various concerns, because all the board members present voted in favor of the staff recommendations without amendment. And then the IASB staff came to the final paper, the one on the applicability of the overlay approach and the deferral approach to the first-time adopters of IFRS. And they analyze here again something that was brought up by a number of common papers, and countries like Singapore, for example, in Asia, or Italy, are going to move either the whole economy or some sections of the economy to a full IFRS reporting basis on the 1st of January 2018. And they're coming from a national GAAP that has got recognition and measurement requirements which are very similar to IFRS, in particular IAS 39. For example, in the instance of Singapore accounting standard 39 happens to be effectively identical to IAS 39. And so, although technically Singaporean entities will be first-time adopters on the 1st of January 2018, they come from a national GAAP, which is very similar. So it's is potentially unfair for those entities to have been excluded from the two options, the two approaches. A different story if you're coming from a cost-based national GAAP, which is very different from IFRS. Then you may be unlikely to actually contemplate the use of the temporary exemption. There is a fine balance, the analysis of the IASB staff paper, between the reasons that would be argued for prohibiting the first-time adopters from applying the deferral approach and the overlay approach, and the ones that would be favoring the permission for first-time adopters to actually be able to apply those approaches in some circumstances. And so, given that analysis, the recommendation that the staff put forward was to modify the proposals in this project draft so that a first-time adopter is permitted to apply the deferral approach when the first-time adopter meets the qualifying criteria, which is that you must use the carrying amount of the liabilities applicable under IFRS and measure the predominance criterion on the date of the assessment, and that the first-time adopter is permitted to apply the overlay approach to qualifying assets And if it does so, it will have to then restate the comparative information to provide balance sheet and income statement on that basis. Very, very little debate here, and unanimous vote following. The logic of this modification to the exposure draft was deemed to be compelling by the ISB members, and so you can see the outcome of that. The last paper was not a technical paper, was effectively the constitutional completion of a standard setting process. We discussed a similar one a few months ago when we talked about the paper covering the due process and the permission to ballot for IFRS 4 Phase 2. There we go again. May 2016, there was a paper that effectively set out the history of this relatively short project, but a very important one, and asked the ISB to conclude whether they felt that there should be a need for a re-exposure, which they said no, there isn't, and they would like to move into publication of the amendment to IFRS 4 without re-exposure, whether they felt that the due process set out in the IFRS Constitution was complied with, and they unanimously confirmed that they were satisfied that all the requirements have been met and sufficient consultation and analysis have been undertaken by the staff, authorizing therefore the beginning of the balloting process. One board member, when he was asked the question as to whether there was any dissenting board member, raised her hand and said that she will dissent from the publication on the grounds that she considers that IFRS 9 is far too important to be handled the way the solutions coming from this project will do, and so she will write a dissenting opinion that will be put on the appendix to the new IFRS. And with that, the next step, very briefly, is now to move forward into what appears to be a very rapid turnaround of the drafting of the amendment to IFRS 4. Publication target date is September, so just after the summer, 4 months from now. This means that from now on we have two insurance-related balloting processes going on. We haven't talked about phase 2 for a while, but we understand that the balloting process is progressing, and a draft of the new IFRS for insurance contracts is quite advanced, and already several board members have been asked to provide their detailed comments on the text. And so from now on we have two documents of high relevance to the insurance industry worldwide that are coming to completion. Clearly these IFRS 9 decoupling amendment to IFRS 4 is going to be a quicker one, and it will be ready in 4 months' time. The other one is a more fundamental change in accounting, and we know already that although the target publication date that the chairman has set of late 2016 or early 2017 remains in place at the moment as the only reference that has been publicly announced, the challenges are not small, and only time will tell if the timeline is going to be met in practice. That is the final message from my webcast today. So I'm going to land the end of my recorded part of the webcast on the final page of my presentation today, and then I will invite you all to submit your questions now after Nikki has stopped the recording.